his own sessions on sector rotation and some of the investments and trading philosophy that traders might look at out there. So today we're going to try our best to wrap those kinds of concepts together and talk about what kind of research we make available here at Fidelity, what kind of tools you have, and what are some of those important concepts that are just good to know, nice to know, and might have some applicability to your trading at home. As always, as we work through today's session, I do want to just spend a little bit of time setting the stage. We have an hour together. Excuse me. So it's one of our longer sessions, which is definitely good. Keep in mind as we go through today, if we're talking about specific ETFs or investments, that there are some limitations. We're not trying to give any guidance, just some information and education. And if you want any closed captioning features, you have that available to you within this Zoom session. Off the top, James, I always like to invite any questions that folks may have. We do have a Q&A tool. Excuse me. So if you have any questions, go ahead and put them in there. Maybe you have something pre-existing. Maybe you attended one of Jake's sessions and saw something and thought, hey, you know what? I'll jot that down and bring it into a session like this. Go ahead and put that in the Q&A tool. We definitely welcome it. As well as any symbols. Now, today's going to be a lot of using some slides and some presentation content we already have created. But James and I were talking offline here and saying we definitely want to save some time for some live demonstration, maybe some other, blank space that we can talk about a little bit further. So definitely put some symbols in there so we can pick on them as we get towards the end of the session. Already got a question that came through from Floyd saying, hey, are we going to talk about the business cycle? Absolutely, we are. So that brings me to the introduction of today's agenda, or kind of what we're going to cover to set some proper expectations. So Floyd, here on the slide, what are we going to cover? We're going to talk about sectors. What is a sector? This is kind of important because we all need to speak the same language. What's a sector versus an industry? How are they divided? What are some of the similarities or differences between them, etc. We'll talk about some of the basic concepts when it comes to the rotation of sectors and why a trader might focus on it. The different methods that we could apply sector rotation. So is it fundamental? Is it technical? Is it a combination? Are we looking at relative strength comparison, which we'll talk a little bit more about down the road? And then Floyd, as you're asking earlier, how do sectors behave within the business cycle? So we're definitely going to talk about that for sure. How to analyze your current asset allocation. If there's time, we'll show that in fidelity.com. Some investors really care about that. Other traders, they're brand new to it, so there's maybe not a whole lot to take a look at. And then lastly, how to find investments for specific sector exposure. One of our favorite tools that we like to show and demonstrate to clients at some point, if we leave enough time, is the ETF screener. A lot of people are going to use ETFs as a source of the tool or the vehicle, if you will, to express their sector outlook. Not always the case, but it's pretty common. And so the the ETF filter and screening tool, very powerful when it comes to concepts like this. So we'll leave some time to talk more about that there. But yeah, James, that's a session here. In summary, I definitely look forward to all the questions that we're going to get and some of the content that we're going to cover here today. But want to pass it over to you and just see kind of what some of your thoughts are when we talk about sectors. What are they? Why are they important? And we'll kick today's session off. Good to see you.
Chase, likewise. Good to see you, and good to see quite a few comments already coming in here. And this is kind of an interesting topic that we don't usually cover because we've historically been more technical analysis focused and as a team, and this is taking it a little bit broader. Now, of course, we do feel that sectors are kind of an important thing to focus on, even if you're not necessarily trading stocks, that you're not trading sectors, because sectors play a big kind of role in what an underlying stock that you might be trading is doing. Now, as Chase mentioned, we are going to spend some time going into the business cycle later. I already saw another question, Terrell, asking about that. And VJ, I saw your question. Just doing a recap of kind of tracking sectors with Excel. That will save for Jake. Jake does his sector session every Wednesday at noontime. So VJ, tune in Wednesday at noon. Jake will be able to help you with that question there. But before we go into sectors, right, we understand that some here already kind of jumping ahead where we are in the business cycle. So you're already familiar with sectors. However, there are some of you that probably aren't familiar with sectors, or maybe you're less familiar than what you think. And the reason why I bring that up is because if I were to ask everyone, how many sectors do you think there are? And I'm curious, I just want to see it in the comments here. How many sectors are there in existence at this present point in time? I'm just curious. All right, I do see some answers coming in. Wow, actually pretty good here. I can tell you I've done this now for a few years, and well, I see some of my regulars here that are familiar with that, but over the years, we've seen some numbers that have been kind of all over the board. So we're going to get into that kind of exact number shortly. But first, just to talk about what a sector is, it's a group of stocks with similar characteristics. Now, in this slide here, you can already see there's a few companies, and this is really picking probably the most notable companies within the technology sector, right? You can see them listed up above. And these companies are in a variety of industries as well. And we'll take a further kind of break into some of the industries. But as you can see down below, this is our sector. And these are our industries. So if someone ever said the software sector or the semiconductor sector, what they really mean is an industry that is within that sector. So for example, some of these kind of industries down below that some of these stocks within this tech sector is that, well, we've got Apple here, which is kind of in technology, the hardware, software, and peripherals. We've got kind of Microsoft here, which of course is going to be software. We've got NVIDIA, probably the one of most kind of known semiconductor kind of technology stocks. So in the semiconductor industry, we have even IBM, which is kind of involved in IT services. Cisco, here we are in communications equipment. So all of these companies, right, we can see at least the similarities. You can probably, even without knowing exactly what the business does, just from what you've heard of the business, right, you're probably familiar that all these companies are involved in technology, and there's just a different breakdown within the sectors. Now, the answer for everyone that answered here, Jason, I'm glad you let them know. I will say the majority of you were spot on here. There are currently 11 sectors within the global industry classification system or standard. And for those of you that might have kind of put something kind of different here, I would imagine you probably kind of got a few industries put in here, or maybe you're thinking of what you learned years ago, because this kind of classification standard has changed throughout the years. It still, to me, feels like yesterday that we went from a nice even 10 sectors into 11 when the real estate sector or the real estate kind of broke off from financials and created their own sector. So these are going to constantly evolve over time. And that's a good thing, right? We want, ideally, right, our economy to continue to evolve and adapt with the ever-changing environment, right? For example, the U.S. economy is very different now than it was, well, 100 years ago, which was very different now than between 100 years before that. So expect to see, right, this change from time to time. Now, these are the sectors, though. So take a moment to kind of go over them. And there are various industries or industry groups, industries, and then further sub-industries. And that's just kind of further way that we can kind of classify each of these companies. But ultimately, when most folks are thinking about sectors and they want to pay attention to what a sector is doing, that is going to be kind of where they're focusing on, just these broadly defined sectors. They're not too worried about the industries. Now, the industries certain industries have been very popular as of late, but still, if you're wondering of how we're going to be talking about this strategy today, Jason and I are going to be focusing on sectors. We're not really going to dive into the industries and sub-industries or industry groups, for example. And when it comes to the kind of distribution of sectors and all of the stocks that make up these sectors, they're not distributed evenly. In the same way that the sectors have changed over time, well, the weightings of these sectors have changed. And again, it's a kind of a great reflection of just the way that in this case, right, we're talking about the US kind of market, the US economy has changed over time. So here on the left-hand side, we've got a snapshot of the sector weighting from 2019. We wanted to show now almost 5 years in the past, so we can kind of show even the evolution of one of the, in this case, the largest sector by at least market cap and how it has evolved. So we've got information technology at 22% in 2019. As of January 26, it currently stands of 29.81%. And we can also look at where the weighting is now when we jump into the live demonstration. Now, of course, it's not going to change much over just a couple of months, but again, it is evolving. And maybe this makes sense, right? What kind of sector has really done well post the kind of COVID low? And that has been technology. Technology not only recovered, but kind of ballooned in market cap. And it is reflective with just the size and the kind of piece of the pie of the overall kind of US stock market pie. And I always like to even show some even further examples here. So if we were to look back in 1990, I don't have a screenshot here, but if we had looked back in 1990, the largest sector would have been staples. And it's funny to think, right? Not just 35 years or 34 years ago at this time, we had staples at number one, followed by energy and the industrials at roughly around 13%. And technology was 6%. And it makes sense, right? Technology wasn't as kind of pervasive and expansive as where we are currently. So technology has gone from 6% all the way until where we are right now at 29%. And that's kind of reflective of how just that overall sector and the stocks within that sector has continued to outperform the other sectors over time. Now, will that be the case in the future? No, right? We don't know. And again, we're going to kind of talk about how to possibly take advantage of some of this specific sector outperformance. Floyd mentioning distorted by the Magnificent Seven, and absolutely right to some extent, right? The Magnificent Seven, which is right, comprised of those, not all, but majority of those tech companies. And again, that's just part of what has attributed to this run up in the overall sector. Now, the one final piece here before we kind of jump into the sector strategies that I want to talk about is some Fidelity data that for those of you, even if you take nothing from the two strategies that Chase and I are going to go into later on, if this doesn't kind of explain and convince you in the importance of following sectors, well, I'm not sure what will. So this kind of pie chart that you see here is based on a study that kind of some of the Fidelity research side did that looked at stock returns between 1990 and 2013. Now, what they found out, kind of the key performance driver of that company's stock performance, well, number one was the company, and it makes sense, right? I can see we talked about kind of Apple here. Apple's success is very much kind of related to the company itself, right? The management, right, that has taken place over time, right? You can say from Steve Jobs to Tim Cook. You can think of other companies, right? Whether they have risen or fallen has primarily been based on that company and, well, how well they're managed, their products, right, and so forth. But when it comes to the second most kind of influential factor, the influential driver of returns was the sector that it was in. And through Fidelity's research, there used to be available on the website here. I think we might have kind of updated it through time, but they talked a little bit more about how they came up with these numbers and this data. But they found that the sector has 22% of the kind of, or is related to this 22% as far as contributing to that performance. Now, what I like to kind of describe it as is a kind of fairly significant, we can say after the company, the most significant headwind or tailwind. Headwind, think of kind of if you're running into the wind, right? it's going to make it a little more difficult, right? That wind is going to slow you down, and you can still be kind of running fast, but it's going to be harder with that headwind. And of course, the tailwind with the wind at your back, it's going to make you feel like you're running even faster. And that's what we can think of how the sector can benefit and hinder that stock's performance. Meaning there could be a company that is doing very well, but if the sector is crashing, for example, if all the other stocks are moving to the downside, they're going to oftentimes kind of detract from that performance of that company. It doesn't mean that the company can't kind of say create a positive return when every other stock is in the negative, but it's certainly making it kind of more difficult, and it's still detracting from that return. Of course, vice versa. There could be a sector doing very well and a company being a laggard in there and in the red. But again, that sector has more than likely kind of benefited or boosted those negative returns. So pay attention to the sector that whatever your stock is in, because that is going to be kind of it's going to have an impact on just what that stock ultimately does. And we can see that by looking at kind of comparisons, where if we take a look at any stock and the sector that they're in, you'll oftentimes see, for most out there, not all, of course, there's no kind of 100% rule that it's always going to work and it's going to show kind of a kind of relationship. But more often than not, you're going to see some type of relationship between what the sector does and what that stock does. So that is meant to at least talk about why, even if you're not going to go into some of the strategies that we'll talk about here, why it's still going to be helpful to look at sectors for the stocks that you are possibly either trading in or investing in. So, Chase, at this point here, unless you wanted to add anything further to what I talked about, I'd say it's time to talk about the kind of introduction to some of the sector rotation strategies that we have.
Yeah, for sure, James. Yeah, let's hop right into it. So hopefully that was a good start to clarify like what is a sector, maybe what it isn't, the difference between a sector and an industry, how different sectors can be, looked upon historically as being a significant factor within your return. So the question then begs itself, James, well, what do we do with that, right? Like, well, okay, now that I have the context, where do I go with it from here? So at a high level, we've got a few choices to think about as traders or maybe even as investors. We talk about this from what we refer to as a sector rotation strategy. And the idea here is that through time, we're going to make small allocation tweaks to our portfolio or maybe even our trading structure based upon whatever sectors we might deem more worthy or less worthy given market circumstances. The reason is because, as James just mentioned, sectors can have a significant impact on those overall returns. And the business cycle, as we're going to talk about a little bit later, is going to play into a bigger part or play a big part in that from a macro perspective. So the rotation is simply rotating or reallocating or shifting allocation, a bunch of different ways we could word this, in and out of different sectors. Now, I want to point out, however, and there's a lot of debate and maybe conversation and difference of opinion within the financial landscape as to what degree we rotate from, right? Maybe that's a whole nother conversation, James, but do you completely get out of one sector and then completely into another, or are you just changing your allocation a couple of percentage points? That's a whole nother conversation to be had, but in neither case you're still going to be rotating, right? It would just depend on the trader's time horizon, their ability to be able to do so, what kind of financial products that they're using, uh, what degree of risk do they want to take as well. So we use the terms like overweight and underweight. Again, that's lending itself more to the fact that you probably still have some allocation across all the sectors, but you're simply going to overweight or have a concentration more so than not in a few of the eligible 11 sectors in general. Doesn't necessarily mean you're getting completely out of one and into another, although I've seen traders and investors talk about that from a rotation perspective. So just kind of keep that in mind. I think more generally accepted means we're just overweighting or underweighting. But again, there's a lot of opinion out there for it, for this kind of concept. So why are we doing this? What are some of the benefits? Well, opportunistic in that we're trying to get some additional performance. Yeah, we could be just in the overall market, but what if we're able to really hone in on specific sectors that maybe historically have outperformed given a certain macroeconomic situation. And if today's that kind of same macroeconomic situation, then logic would hold. Well, maybe we should overweight that sector. We try to get some of that extra outperformance if we can. Defensive. This is a different way people can look at it. You might be getting to a different phase of your earning cycle as an individual. Maybe you've gained a lot of wealth and you said to yourself, okay, well, I don't want to take the same kind of risks I had to take to earn it. So maybe I'll do some more defensive sector rotations to help manage some of this, choose some historically more conservative performing sectors, but they also have that requisite conservative type of risk that's associated with them. And this preemptive concept, right? So help protect against inflation. There's a variety of ways that we can do that. Definitely an argument that today that's probably more important than ever, given what folks are seeing. So when we take a look a little bit further into some of these slides, so why would someone do this, or how are the two schools of thought? One is to create a long-term strategic allocation. This is really more of the investor basket, if you will, number one. So if you're more of and again, I think about it on a spectrum. You have investors, you have traders. You don't have to be all or none, but your assets might be located or targeted in a certain way. For example, James and I are employees here at Fidelity Investments. We have 401ks. Those are investment type accounts, typically more longer term. Could you trade in them? You probably could, but that's why we have trading accounts, individual accounts. We can sort of segregate our assets, our time, and our effort, some into investment buckets, others into trading. So the second category or approach would be you're taking a more active or tactical or maybe a shorter term position on trying to get the outperformance based on either the business cycle or maybe more of a trading philosophy as opposed to investing. So how does this work out historically? Right, let's give some context. So this is some Fidelity research. Now it is a little bit older, but that's just how some of this research works, right? It takes some time to go through, allow things to occur, then go back and really review the performance. So what we're looking at here is the rolling 36-month volatility, annualized volatility in drawdown risk charts, if you will, being compared against the benchmark and in a risk managed sector portfolio. Again, like James was saying, we used to have a lot more of this on the actual website. We could break down a little bit further detail, like what was the benchmark versus what was constructed as a risk managed sector portfolio. But we're really just trying to use this more of a concept than the specific solution. And what we're trying to show here is from an annualized volatility perspective, we have reduced volatility. And volatility is going to be one of those major measurements that people use as a proxy for risk, right? Like, hey, if things are moving more, there's more risk to me. If they move less, there's less risk. It's one of the lenses or views of risk that most traders and investors have. Maximum monthly drawdown, that's going to be significant, especially again, if you're someone who's trying to preserve wealth as opposed to maybe create it in the earlier stages of your wealth accumulation, financial journey. And so that risk managed sector portfolio, which again is trying to rotate in and out of sectors based upon historical performance, we're seeing a significantly lower degree or lesser degree of maximum drawdown. Okay, that's going to be important to some traders. So what does this really come down to? The volatility of the risk managed portfolio on a rolling 3-year basis was consistently lower than the benchmark over the past 45 years. Now, of course, that time frame going back to like the 1970s to 2012 here, the data being published as of 2015. So has this changed? I'm sure it has to some degree. Maybe it's gotten a little bit tighter, maybe wider, who knows? But as we get more research like this, of course, we'll share it. And then I love this slide. This is really interesting here. Again, it's a little bit dated, but the gist of it is what we're trying to share with folks here at home today. And that's going to be bear markets, right? How many bear markets have each individual sectors been exposed to through time? Now, granted, with COVID 2020 sell-off, pandemic sell-off, I'm sure some of these numbers would be updated and changed. But what we're trying to factor in here is there some kind of trend? Are there some sectors that, for whatever reason, happen to just to experience less bear markets? And of course, we're defining a bear market as at least a 20% correction, right? These are as of 2015. Well, utilities and consumer staples combined over that time frame had as many total bear markets as just information technology, for example, right? So we can see historically speaking, if someone said, hey, Fidelity, what are some sectors that historically speaking have had the least amount of significant drawdowns from a specific sector approach? Well, the research shows us factually it's utilities, consumer staples, maybe telecommunications, as of this point in this research. We can take a look over at this blanket, if you will, or this kind of quilt of information tiles. There's a few different names for this kind of organization here. And what we're trying to show here is the lowest volatilities are highlighted in green, the highest are in red, and then we give you a bunch of different data sets. So what do we see here is the lowest volatility, again, consumer staples having a lot of those green uh, sort of boxes or shading, and utilities having two or three of them here as well. Healthcare, relatively lower volatility as well. Where do we see a lot of red? Information technology, telecommunication, financials. But let's look at that 12-month absolute returns. And we can take a look here. Utilities 15.4 compared to information technology 26.7. So what this is trying to show here, right? Not just trying to throw a bunch of data at you, is that there's this risk to reward balance that the markets seem to respect through time when it comes to sectors. Some sectors just have a lot less volatility, but do some of those returns that come with them are lower? We can see that, right? So we just want you to be mindful of this as we talk about rotating. Like, hey, do I want to get out of healthcare and go into utilities? Well, historically speaking, utilities probably has less volatility. Okay, but it also may have less absolute returns to the investor. Are you willing to make that trade-off? Where are you in your financial planning, your financial situation? Do you have cash reserves on hand? Are you already significantly invested in something like the S&P 500, where you're probably going to be overweight information technology to begin with? It's like, where are you in that overall picture? These are definitely good concepts to keep in mind. I think where this really comes alive though, James, like this is just data. I think at this point we're still trying to weave that narrative and that story of why. I think this becomes more impactful when we talk about the business cycle and what that means relative to these sectors through time. Do you want to maybe just talk to us a little bit about that?
Yeah, I'd agree. I think when folks are thinking about trading sectors or creating a sector strategy, they are thinking it from the business cycle perspective. But right, to some extent, right, this, even if right, it to some sense it is designed to minimize returns when you're kind of diversifying your portfolio or your trading assets into a more minimum volatility, a lower risking type of kind of equity portion. It still has its merits where if we don't think of it as kind of like an all or none, right? Some could look at this and say, okay, well, if utilities, consumer staples, energy, healthcare have, we'll say, lower kind of or lower volatility, fewer number of drawdowns, I'm just going to go in those companies. Well, no, it doesn't have to be that way. And there are some traders that I've spoken with from time to time. Now that technology is about 30%, they're thinking to themselves, well, hey, in the past, I didn't mind being kind of broadly diversified and somewhat weighting my stocks or my investments based on what sectors are, right? That market weight, so to speak. Now that technology is such a large component, you could take the approach of, well, I'll just kind of minimize some of these more kind of volatile sectors from my portfolio instead of having 30% technology, which is market weight, right? 29 point something change. I'm just rounding up for 30. Let's drop it to say 20% and then increase some of these historically less volatile sectors. So it's an approach. I think it's certainly valid, but to chase your point, I think most folks are going to be looking at the kind of business cycle analysis perspective. So that brings us into the kind of second sector rotation strategy, and really where we're going to spend the majority of the time, and that is choosing the kind of stocks and choosing your sectors based on the business cycle. And again, for those of you that don't trade sectors, you still might trade stocks within particular sectors based on where we are in the business cycle. So in order to kind of really tie this in the same way that we spent some time going over what sectors are, what are industries, Well, let's talk a little bit about the kind of business cycle. Now, this is a way to think of not necessarily the stock market, but the overall kind of US economy, right? We've all heard the term recession, right? The economy's in a recession. Okay, right? There's more to just the recession point. There is what's called the early, the mid, the late, and then finally the recession phase. And there have characteristics that are kind of related to the growth of the economy, whether it is, say, growing, economic growth continues to rise, as we can see in this recovery phase, the early and the mid, and then in the decline. Now, understand that all because it's declining doesn't necessarily mean that it is kind of shrinking. This decline that we see here is characterized by still economic growth, right? Still a positive GDP, but the GDP we can say isn't increasing, right? It's lowering. So let's say we're looking at a kind of 1.5% to 2.5%, maybe a 3% up at the top. And now we're back to a 2.5%, a 2%, a 1.5%. So it's still positive GDP. It's just now kind of that growth rate is declining. And it is in the kind of recessionary phase is when we have that negative GDP. And there are a few kind of, I guess we can say, kind of characteristics that help of the researchers here, the analysts, figure out where are we in the early, the mid, the late, and the recession. Now, I'm not surprised how we got quite a few questions in the beginning that asked, well, where are we in the business cycle? Because it's not that we have a website that we can go on to in the same way that we can look at our the US debt clock, for example, where we can kind of get a rough idea of where the debt is. We can look at data to tell us what the GDP is, but we don't really know exactly where we are on the business cycle. It takes kind of analysts to kind of put out their projection or their kind of best guess of where we are. But there's some characteristics that are defined to each kind of section here. We're early. Think of this as when kind of sales are recovering. Inventories might still be low, but sales are starting to recover. We can think of this as almost after we went through a very quick business cycle surrounding COVID. But when things started to recover, sales were improving, inventory was still low. Fiscal policy is still stimulative, which is what we saw again, kind of post the COVID lows. And the early cycle is typically roughly 1 year. So again, that's going through history. All of the time frames is based on historical analysis, and it typically lasts 1 year. And it is the phase with historically the highest performance. So this is where you're going to see those sharp kind of returns in the stock market. Think 2020 after the COVID lows. When we get into the mid-cycle, which is typically the longest phase, this is where we see growth starts to peak, economic activity kind of gathers momentum, inventories and sales are finally kind of reaching an equilibrium where they're at their target. And as being one of the longest phases, this is going to last, if history is a guide to us, about 3.5 years. I always like to say 3 to 4, we can say 3.5 years here. And in this phase, as being one of the longest, this is where you typically see that higher than expected return. If depending on your time frame, when folks are considering what the average annual expected stock returns should be, 7 gets thrown around a lot if they go quite a few decades back. If they just go the past few decades, comes to 10%. But the average annual stock returns in the mid-cycle has been around 12 to 14 years. And something I found interesting, in the mid-cycle, that is when the kind of sector differentiation, the differences between the sector are the least. So if things are growing, everything is kind of growing, and it's not that kind of drastic, we'll say severe outliers both on the upside and the downside. This is historically what we're talking about. It's not every single time, but historically that has been the case. Now, late cycle, which is where we are in the snapshot, is when I think this is credit starts to tighten, Fed policy begins to tighten. And hint, right, for those of you wondering possibly where we are in the business cycle, look at the characteristics. This is where growth is moderating and earnings start to fall under pressure. Now, the returns in this period are typically around 5%. I want to say it's 5, 6%. And this is a little bit longer than the early. It's typically 1.5 to 2 years. So it's longer than the early phase, less time than the mid phase, but still longer than the recession, which brings us to the recession. And that's when your sales fall. That's when profits fall. This is where kind of credit is going to be fairly low. Folks aren't spending, they're hoarding their money, not only the consumers, but also the businesses as well. Now, the good news is the recession has typically been historically the shortest time frame, less than a year, and the average annual return is a wide range I've seen, but around -10 to -20%. Now, within these phases, we've talked about there's different time frames, there have been different historical returns, there's differences between what the Fed is doing, what credit is like, what sales and inventories are. Because of that, during these phases, some sectors tend to do better than others. Some sectors tend to do worse than others. So this really is how we tie in the sector rotation strategy. And what it has historically meant is that investors and traders will not ignore a sector and not go all in on one sector. But historically, the way to play this has been to say overweight the sectors that have in the past done well in that business cycle and underweight the sectors that have historically done poorly in that business cycle. Now, it's not going to behave this way every single time, but throughout the years, if you're at least trading, purchasing stocks, and possibly minimizing your exposure to stocks in the underperforming sectors, while maybe overweighting stocks in the outperforming sectors, that could lead to that what's called the extra alpha, the extra kind of risk-adjusted return by going into these kind of positive or double positive sectors. So what we're looking at here between the double positive, positive, single negative, or double negative are these sectors that have either have done well or consistently kind of beat the average returns during that time frame. And it's a little bit tough to see down here at the bottom, but we can see the unshaded white portions suggest no clear pattern of over or underperformance versus the broader market. Double plus or minus indicate the sector is showing consistent signals across the three metrics of outperforming. The single positive or negative indicates mixed or less consistent signal of outperforming or underperforming. And we could see that, just to pick industrials here, does poorly in recessions, very positively in the early cycle, and more so, no real clear distinction in the mid and late cycles. Some sectors, information technology, it's either outperforming or underperforming. Others, it can have periods of time where no clear distinctions. We talked about healthcare and industrials. So the business cycle can be viewed as a fairly kind of longer term time frame than especially what most traders are doing. This is just a way to define sometimes commonly used terms when you're studying the business cycle. There are secular trends. This is over the periods of decades, 10 to 30 years. The business cycle is over 1 to 10 years. And then the kind of tactical approach, which is what Chase and I are talking about here, 1 to 12 months is where you're kind of going into the particular business cycles, not riding out a full business cycle, which could take, say, as long as 10 years or as short as 1 year, going back to the the pandemic lows, where it's viewed as going through a full business cycle in a very, very short period of time, which contrasts with prior to that, where the business cycle went for an extended length of time. The tactical trader is going into stocks kind of based on where we are in the business cycle, and either remaining in those stocks through multiple phases, or trying to time when those phases are and adjust accordingly, going in to the sectors that are, or overweighting sectors that have done well, underweighting sectors that have done poorly. So now that ideally, I think many of you are probably familiar with the business cycle, now let's talk a little bit about kind of where we can find this on the website, answering probably the most kind of common question here. So with this, I'm going to jump over to fidelity.com and go over to our kind of markets and sectors research page. So in order to find yourself here, you're going to want to go to news and research up at the top, and then click markets and sectors. Now, since we were talking about sectors, you're going to want to click on the sector link at this point. Now from here, this is where you can get a kind of a rundown, at least from a today's perspective, how the sector is doing. We can filter this. Well, energy and information technology, right, leading the way. Consumer staples and real estate being the laggards of the day, and the S&P, which, right, you'd imagine it's never going to be at the top, it's never going to be at the bottom, because the S&P is a kind of mixture of all of the sectors are within the S&P. It's going to be oftentimes tilted towards the kind of better or the larger sectors, right? We know information technology, and we can see this on a year-to-date basis. Communication services and energy at the top, going back over 10 years, explaining why the information technology sector has become a bigger and more important component of the overall US stock market, up 500%. Looking over there at U-Energy, who has continued to shrink, I'm sorry, just due to the passing of time, because it has underperformed against the overall stock market. Now we do have the business cycle, where you can view the similar data that was showed on that kind of phase wave, in this case in a table form. Scrolling down will take you to where you can find a little bit more about a particular sector. So let's start with, actually, we were talking about information technology, right, being 29%. That was as of January. We're still hanging in there, 29% as of today, or in this case, as of Friday. But let's start with the very first one, just communication services. For any sector, you're going to be able to find similar details. If I were to expand this, they're going to give us the market cap, the market weight, the, I guess we can say, opinion by a specific analyst, in this case, CFRA, whether a trader would overweight, underweight, or market weight their trade and investments. We can see a chart for communication services and an industry breakdown down below. Now, to answer everyone's kind of question, or the most common question here, if we click on view current phase, and there's a few ways to get to this page, but I would suggest view current phase. So again, news and research, click on markets and sectors, then click on sectors, and then finally view current phase. This is going to link you to the institutional side of Fidelity, where you can find some of the best researchers here publishing kind of data on, well, sector analysis. So here's the question, right? VJ, Floyd, I believe, was asking, well, Terrell was asking, where can we find the phase of the business cycle that we're on? Well, it's going to bring you right there. And we can see not only the US, but also other countries, for any of you that are interested in international kind of investing. When we click on it, it can show where we have been. And you might notice, right? Did anyone catch that? Q3, 4, 1, and 2. Right, we're in Q2 at this point in time. It's not necessarily do we have to go from left to right. Why? Because the economy is somewhat right. It's adapting, and no one knows where it's going. What I like about this is where were we at the end of last year, right, in Q4? We were expecting this year we would possibly have that, right, soft landing or hard landing, no matter how you want to call it. We were expecting some type of recession this year, and hence why we can see the analysts in the past putting us in the very end of late cycle, right, on the verge of a recession, because we were expecting that to come. But what is this most recent update? They actually moved us back, right, based on the data that's coming out, looking at some of the GDP numbers. And for those of you that attend our regular sessions, we show the Atlanta Fed's GDP Now report. That happens quite a bit, where you can see, based on data points, how the GDP is changing. Well, what we found, hence, and of course, why the Fed hasn't cut rates, why we went from thinking we could possibly get a cut in the first half of this year, maybe even as early as March at the end of last year. Based on the data, we found that the economy, well, to maybe somewhat of the stock market's kind of disappointment here, is still stronger, right? It's still, to some view, as still a fairly kind of hot economy. So what has happened, they've actually backed it up. We're not as close to the recession, at least this is based on the analysts, we're not as close to the recession of where we thought we were back in Q3 and Q4 and even Q1 of when we started Q1 this year. So don't think it's a mistake that it jumped backwards. It's just kind of how the evolution is. As we interpret the data, we can kind of slide ourselves of where we are. I know you're going to tell me, well, then how do we trade for this? Well, it makes it difficult, right? No one's ever going to say it's going to be easy. If it was very easy to do this, we would almost be outperforming the S&P by a significant margin, right? This is for you kind of independent investors and traders out there that want to try to achieve this extra alpha, knowing that you may or you may not. But ideally, looking at this data could help, because maybe the uninformed investor might be thinking to yourself, okay, well, we're about to go into the recession, not looking at the data that says, well, it might still be a little ways away, based on the experts. Now, if we were to scroll down here, there's a few places that I would want to take it to. And Chase, I'll let you take some of the questions shortly here, but let me at least show kind of a few additional links when we scroll down. Because again, since you all are in here, you take that active approach to your own investing and trading. We don't have oftentimes as individuals the resources that some of these kind of folks that work here at Fidelity that have teams working for them. There are two reports. We call it, in short, the QMU and the IRU. The investment research update used to be called the kind of sector update. The name changed, but it's still going to be primarily based on sectors. So if you go to this investment research update, it's going to bring you to the research that fairly popular kind of Fidelity director here, and this is Denise Chisholm. This will bring you to the most recent investment research update, which I still view it as the sector update here, but this is where you're going to get updates on the sectors. You can watch the video, launch the presentation, and you can even find the full report. So I'll try to open this up in a tab. There we go. So that second quarter sector update, now you can, of course, kind of watch Denise explain this, but you can even find some of the slides where she goes into the summary, the scorecard, more so some of the data. And you can see, I'm just kind of scrolling down here just to show kind of just in high level of what it looks like, but you can find some of her updates on the oftentimes sectors, which are going to be kind of focused on. She'll give a take on the sectors. In addition to the investment research update, there is the quarterly market update. Now this is from what is it, Jake Weinstein, and again, you can watch the video. This is done once a quarter. We can scroll down pull up the full report. I will just show, of course, we don't have time to go into all of this here. However, it is going to break down more so from the economy and macro backdrop. I like to think of it, if you can recall the kind of the secular trends versus the business cycle, Denise oftentimes focuses more on the business cycle, and Jake here goes into some of the kind of secular trends from a very kind of broader background. But both of them can be beneficial if you're interested in taking this hands-on approach. And then finally, if you want to learn a little bit more about the business cycle approach to sector investing and asset allocation, this is it here. So the presentation here that Chase and I have described today is based on some of this research. This will be the last kind of thing I'll show. And again, I'm not going to go through each page because there's 12 of them here, but this is going to break down the business cycle approach to sector investing. This is where some of that data was pulled from, as you can see, right, directly from this presentation in the past. So that's going to be where, if you're interested in doing a little bit more research kind of on your own, you'll be able to find some of it.
Hey,
So
James, just real quick, sorry to cut you off.
no,
We
I'm
had a few
finished here.
questions come through. Can you just show us one more time how to find that landing page that you went to find those separate links one more time to the institutional website?
Of course, of course. So again, let me just go from the start. News and research, markets and sectors. You're going to want to click on sectors. And then finally, view current phase. So everyone, this view current phase is going to be the place to take you to the institutional page. So hopefully that helps. And yeah, Chase, I do see quite a few questions come through. So I'll let you kind of tackle either some of the questions, or right, if you want to maybe show anything else that we could use, by all means, I'll pass the mic over.
Awesome. Thanks, James. Appreciate it. So a few things came through. We had a couple questions that came up about how do we use some of this information on a more tactical basis or shorter term, maybe more of the trader's perspective. I think a lot of what we talked about is certainly applicable to more of the investor mindset, if you will. But one of the ways that we go about this, and we talk about this fairly often, I would say, on our team, is the relative strength comparison type of analysis that we do. Just by a raise of hands, who's seen or heard of that before? Relative strength comparison. It's technically a technical indicator, but it's also more of like a process or a mindset in the way that we teach it here in the desk. Got about 100 people, 5, 10 raising their hands, about 10%. So this is definitely worthwhile going and covering real quickly here, James. So what we can do here is go into Active Trader Pro, which is what this chart depicts, and essentially compare a given sector to the S&P 500 or to different sectors against each other, and find out for ourselves which sector has strength relatively or relative to another comparative ETF or indice. So let's do that real quickly. We'll demo that and we'll tackle some questions as we wrap up the session. For anyone following along at home, I'm going to Fidelity Active Trader Pro. We'll pull up a blank chart just to start here today. And what we can do is we'll just start with the S&P 500. So I'll type in SPX, okay? And funny enough, here at Fidelity on this desk, we have a watch list that has all kinds of, different things in here. But one of them that we have is the sector indices. So these are the official symbols you can type in Active Trader Pro. You can pull these right from fidelity.com as well. I just have a list of them here. So we could take any single one we want. Let's just start with this .gspe, right? So we'll go ahead and hit comparison .gspe. If we put the two of these in together, what we initially get is going to be a comparison of price returns through time. Not necessarily total returns, but price returns. But that's not quite what we're interested in just yet. What we want to do is add an indicator. So we'll go to indicators, go up to the top, and we're going to type in RSC, relative strength comparison. And we'll click on that to add it. What we get here, James, is an understudy down below. Now I've expanded it just so it's a little bit more apparent and easier to see. And we often get questions like, hey, what does this number off to the side mean? Do I care about 7.21? Not really, no. What we're looking for is the direction or the trend of this line. What it is telling us, visually speaking, is does our source symbol, in this case SPX, Does this have underperformance or outperformance or overperformance relative to the comparison security or indice or symbol? So what do we see here? This line is declining for some time, then leveled off and has come back. So what is the narrative? On a year-to-date basis, the S&P 500 was about equally performing, is about flat overall relative to the sector selected. Then it underperformed that selector, kind of leveled off again, and now it's starting to come back. Interesting. What if we switch this around? So let's do .GSPE at the top. We'll change the comparison, so we'll get rid of that. So it's just the energy select sector here. We'll go back to comparison and click S&P 500 one more time. The curve is the complete opposite here, right? We can see this scenario, but it's the same story. It's just telling it from a different perspective. What this is saying is GSP, or the energy sector, was about, on par, if you will. There wasn't a significant strength over the S&P. Then it had significant strength, kind of leveled off again, and it's waning. So it just depends on where you're starting your comparison from, but ultimately it's going to be the same story here when we compare the two of them. Okay, so you might say, well, that's nice, Chase. Why do I care? Well, we can take this a step further. We can go ahead and hit add indicator, then add a simple moving average to this line. It's going to default to a 20-period simple moving average. And the idea being is we can start to generate, from a technical analysis perspective, some signals as to maybe when we start doing some of that rotation from a shorter term perspective. So when we get this crossover a couple times here, right? Maybe this is a little bit of a false breakout. Then we get another crossover, tries to retest, continues on. When you see this, oh, okay, that tells me as a trader, energy is currently starting to outperform the broader market, the S&P 500. Maybe I think that trend's going to continue. Someone just slightly overweight. I'll shift 2, 3, 5%, whatever the number might be, just making that up as a demonstration, into energy until I get some kind of signal that its outperformance relative to the S&P, when this purple crosses back beneath it, has waned, has changed. It's no longer outperforming in that same strong manner. So this is kind of how we loop it all together in terms of, yes, we've got the fundamental analysis, we've got the research, we've got the historical. A lot of that tends to be in the longer term. But what is a way a trader might look at this on a shorter term, a more tactical or approachable perspective? And this is just simply one way to do it. Now, this is comparing energy specifically to the S&P 500, but we could compare it to something else. That's totally fine as well, right? We'll pull back up our watch list. We can take a look at any of them that we have here. .GSPU, we'll put this instead. So .GSPU, we're going to take a look at utilities, and we'll compare that to .GSPE, energy. If I typed it as .GSPE, yep, let's try that again, .GSPE. Pull that up, and now we've got utilities compared to energy. Okay, so what's the story here? Well, look at this line. It's decreasing for quite some time until recently. So what does that tell us? Well, utilities was significantly, or at least nominally at the very least, underperforming energy for most of the year, probably the first half or the first quarter. And then recently here, towards the end or midpoint of April, that changed. We can see some of that strength coming back in on a relative basis. So when you see that kind of cross as an example, that might be when a trader says, this could be the time from a timing perspective, I start doing that rotation. Again, doesn't have to be an all or nothing. It can just be that starting point. Or you might just say, hey, I see this happening. I'm not quite ready to take action, but now I'm gonna watch closely, right? Maybe now I'm gonna look at the chart itself as opposed to the relative strength of these two symbols. Maybe I'll do some more traditional technical analysis, look for support, resistance, trend analysis, all the things that we typically talk about here on a trading strategy desk. But this might be that initial event that says, oh, something has clearly changed, relatively speaking, between these two particular sectors. Might be good to know. So James, that's like the more, I would say, tactical or technical approach that someone might use. Again, it's that relative strength comparison process. Again, if I pop back over the slides, I know we're coming up to time here on the session. What else could a trader do to make this more approachable? All the things we normally talk about, right? Look at the chart, put some simple moving averages on, draw your trend lines, do some of your more typical trend analysis, maybe look at momentum. I know I saw a question earlier about can we incorporate momentum into this process? Absolutely. You could put a momentum indicator on two different charts, compare them. I've seen people use the relative strength comparison as their version of momentum in a way against the two to compare against the two securities and say, hey, if there's a big move in that relative strength, there's been a momentum shift, if you will. So you could look at something like that, for example. We're coming up to time here, James. I know we're right on the money. There's just a few questions I'm going to stick around just the next minute or two to answer, kind of a round robin as quickly as we can. So VJ had asked me or us, can we do this on a weekly basis? Of course. So this chart defaults to daily, but you could certainly zoom out if you wanted to and just change the frequency to weekly if you'd like to. Just keep in mind now, of course, the source data for the technical indicator is now weekly. Same thing with the bars. So absolutely welcome to change this however you see fit. We just use the daily to start. You could go even further if you want, go to like a 10-year monthly and start looking at it at a much more macro perspective. Again, investor versus trader, like what are we looking to accomplish? What's our risk? What's our time frame? A few other questions that came through. So Teresa saying, how can we get the same watch list? Yeah, so what we did here, Teresa, we'll go back to fidelity.com for just a moment. So under the markets and sectors page, we have our sectors here. And so if you're looking at any of these, if we click our drop down for just a moment, this used to be a little bit simpler until we updated the page, but it's not a huge deal. If you take a look, if you click down on any specific sector, it actually gives you the symbol. So the .gspl, for example, for communication services. Once you have that symbol, I just go to Active Trader Pro, I go to my watch list, and I add the symbol there. So let's say we've got the .gspl, hop over to ETP, click on it. Let's say you're on your chart, .gspl. We'll get rid of all the other stuff for just now. You can right click, and then you can add to watch list, and then add it to whichever one you want. Our team, just went ahead and we did that manually to add all 11 into a watch list so we can just use it pretty quickly. So that's how you go about doing that. And then the last thing I want to cover here, James, unless there's a few questions that stick out to you, again, I don't want to keep anyone over time too long today, is provide some follow-on resources. Like what can you do next? What do we have available for you as a client? So on fidelity.com, if you go up to the top right-hand corner and you search the word sectors, so sectors, hit enter, brings us to a landing page, and you can sort whatever you're looking for. If we sort any content type to a video, we click video. We're going to have a few things here for us. I'd encourage you all to look through them. There's going to be like, plentiful resources there. But this one's research best practices, a focus on sectors. So the second link right here, a research best practices, a focus on sectors. If we click on it, it will bring up a recorded webinar that our team previously did on a topic like this. Might not be exactly the same as what James and I talked about here today. The slides have probably changed. The examples we used have probably changed, but the core content is going to be relatively similar. Comes with a transcript and slides that you can download, which are probably going to look fairly similar to what we talked about here today. So I would encourage everyone to take a look at that. Again, on fidelity.com, go up to the top, search sectors, and then use research best practices, a focus on sectors. And then, James, I apologize if I'm being redundant. I don't remember hearing you say this, but again, I was looking at the Q&A for some of the presentation today. If you're looking for a Denise Chisholm type article on fidelity.com without going to the institutional website, one of the easiest ways is just to type in fidelity.com QSU, quarterly sector update. Again, if you already mentioned that, James, I apologize, but you just type that in. It's going to bring you to the article that we have right here for you. So if you're looking for a quick way to find it, that would be it. James, I'll pass it over to you and wrap us up with any final thoughts, any questions that send out to you on sectors.
Oh, no, that is fantastic. I do want to be respectful of everyone's time. I know we're already 4 minutes over. And of course, in this session, we always get quite a few further questions. And what I would say, especially when it comes to sectors, now that we have Jake going into sectors every single week, join us. It's going to be Wednesday at noon. I believe it's just 30 minutes, even though it says noon to 1, but join us at noon on Wednesday. You can have one of our colleagues, Jake, do a further kind of sector breakdown and can assist you if you're interested in learning more regarding sectors. But I'll leave it there. Hopefully you found this session helpful, right? At the very least informative as to what sectors are, a few strategies that you could use to incorporate sectors in the business cycle and how it could at least benefit your own stock trading. But until next time, everyone, please be safe out there. Best of luck on those trades, and hope to see you on another session, possibly very soon. Thank you, Chase.
Thanks, James. Thanks, everybody. Take care. See you.